All right. Hey, welcome everybody to another Ask Me Anything. We've got our loyal crew here, minus Mr. Chris and Mr. Steven. They're actually down in Dallas hosting our Money Tank event right now. So I know we got a lot of people on there. Actually, it's kind of cool. I've had some people on the WTF and Wealth Wednesday that were actually at the event and listening to this at the same time to our live stream. So that was pretty cool. And then I had Shane Hollingworth come on board onto the Wednesday webinar and kind of share his story. And he was at the event walking around. It's kind of cool. So, but guys, go ahead and get your questions into the air right now, and we'll be back in 14 seconds. All right, everybody, go ahead and get those questions into the comment box. Get your questions answered. So we'll go ahead and go around the room real quick and do some quick introductions. Obviously, I'm Brian Fouts up here in North Idaho. And yes, Jason, my shoulder is in massive pain today and not any better or getting any better.
You keep reading my mind, man. I was going to ask you when it got to me, but you're already answering. I love it.
Yeah, I have to have an MRI scheduled. Been extremely challenging getting that scheduled with the doctors and stuff because I live an hour and a half away. But man, it's on fire today. I don't know what's going on, but hopefully getting better here soon. But yeah, spending a lot of my time cleaning up my property that I moved into and finding a lot of things that I don't want to find in our house that need to be fixed. So that's my journey right now. So with that, I'll go over to Bree.
Oh, hi, I'm Bree Shaw up here in Chuviak, Alaska. Still a little bit cold, but sun is coming back. I've just been working on my Mustang. I'm hoping your shoulder gets better quickly. I didn't know too much about that. But yeah, I'm just hanging out with my Mustang, looking for any excuse to go driving and enjoying recapturing all the money I'm putting into it. It's a darn good feeling. We'll go ahead and censor that a bit. It's darn good to know that I'm being my own bank and getting to play with fun toys. And just like Chris, I hope I catch the bug. I don't know if I'm going to go in the direction of a Porsche per se, but just going to keep elevating, and I'm looking into new horizons, and it's exciting. But yeah, excited to join in today. Always looking forward to the Ask Me Anythings. With that, I'll carry it over to Jason.
Thank you, Bree. What's up, all? We're back for another version of our Ask Me Anything with the WTF background, just having fun, holding down the fort, answering questions, having a party while we're doing it, some music playing. I don't know if anyone else is hearing that. Thank you, Carson. But excited to be here with all of you. Get your questions in so we can answer them. If you don't have them, we will just keep talking. Any one of us can talk the whole entire time if you don't ask questions. So I'm threatening you with that. That could happen. I'm moving down to my man, Ethan, right here on the I team. So say hey, Ethan.
Hello, everybody. Ethan Evans here from the implementation team. Just glad to be here, joining in and answering all your questions. I've just kind of been in a nice grind and rhythm of meeting new clients as they're coming in. Either policy is just going in force, and I'm getting to meet them for the first time, and really taking that strategy that they worked with their money mentor, and then putting that into motion and in practice, and really just making it very tactical and hands-on of here's exactly the steps you do, and how do we go about recapturing all this money. So yeah, excited to see your questions. So that's all for me. Off over to Carson.
I love it. Guys, everyone on here is awesome. Thank you guys for being here every week, all you listeners. I hope we don't bore you guys with similar stories and similar examples, but obviously we don't because you keep coming back. So thank you guys for wanting to support us, learning infinite banking on a deeper level. And I'll wrap it up with right now I am well, I'll show you actually. This morning I filmed the podcast. See if you can see on my phone here. This was the podcast angle sitting over the beach.
Whoa.
And there was some sweet surf going on.
That's like Dana Point.
So it was pretty good morning. I was able to go surf, came right up and filmed the podcast. So couldn't be any better, and doing well over here in California. So we're grateful for you guys' questions. Always bring these. Let us know what you guys want to learn more about, hear more about. We now have the next 50 minutes for you guys to do whatever you guys want. So we have a few questions already here in the lineup, and keep them coming.
Yeah. Now, one very important question. Bree, what year Mustang?
Okay. don't hate on me. It's a 2017, but it's a 5.0 manual GT. So
Okay.
I just wanted a manual. I even took it being red. It's not ideal, but it works.
My first one was in 1965.
See, I'm a little bit jealous. And I heard there's a company that's now specializing in taking old cars and modernizing them because let's face it, cars used to be gorgeous. They really took pride in the curves of some of those really artsy fartsy ones that make you look like you're a villain from an old comic, and the gangsters and mobsters all had them. Those ones, they're putting modern compartments and engines and bits and bobs and brakes and things into them so they keep the body, but it has all the power of today. Like they were putting one of those, what was it, 1200 horsepower Hellcat engines into an old Camaro, and I was like, all right.
Yeah. I have a T5 in my 67 Mercury Cougar, so it's a modernized, as you said. Yeah. Well, cool. Let's dive into the first question we got here. So I'm gonna go with the one that Shauna brought up. This is a great one right here. So question, what's the best money problem that you solved this week, or that, we as obviously mentors and strategists and IT members, what did we solve? And so it's kind of cool. So I don't know if anybody, I know some of you guys were on the Wealth Wednesday, but I went through like about 7 or 8 case studies on clients and what they've done and what they've solved. And so kind of bigger picture almost is what a lot of our clients are doing. So if you didn't see that presentation or run on it, go back and watch the Wednesday Wealth webinar when it's available here this weekend. There are some cool case studies inside there, some really cool ones that I found. So definitely check that out. But man, anybody have any stories from like this week or last week, problems they solved for clients? Lots.
Don't all talk at once. Don't all talk at once.
I'm trying to think of a good story for you.
I don't have a good story. I'm going to keep it simple though. So one of the things that's been coming more common lately, I'm getting a lot of feedback after people are putting their policies in force, even after they met with the implementation team, taking a loan. Then people, my feeling, and you guys can tell me if you've seen the same thing, but is, your journey does not start until you put your policy in force and start using your banking system.
Mm-hmm.
Like that doesn't mean you're a banker at that point. It means you've started the journey. And so the question I get that's really common is like, okay, Jason, I've taken a loan, I paid off one thing. Now what do I do? How do I use this? And it usually is followed by this and this and this happened in my life. It's not going as well as it was. I'm not making as much, or something's changed. That is life. Like one guarantee in life is there's going to be change. And so like if you've paid off a loan and there was a certain amount of money that you freed up that used to leave your family and it's coming back, well, if you would have kept making that payment in every other situation back to that other family, so you didn't lose the car or the thing that you had financed or wrecked your credit, you want to find a way to make sure that money comes. Oh my goodness. Now that is a terrible too. Look at that.
Quick, we got to get into work before we play.
So I would say just remember that your journey is just starting. And if you don't know something, just make sure you remember the simple principles of paying yourself back when you free something up. You keep making your premium deposits. You keep making your loan repayments back to your policy. You have flexibility with it, but it just starts.
Yeah. I'll say a good one here that that actually was something that did solve a problem. Is I've had some clients coming in from a certain source, and they're military people usually, and they have
Hello from Dallas. Can you hear us okay?
No, we can't hear you. Quiet.
No.
Can you hear something? I think their mouths are moving.
Yes, can we get an introduction from YouTube real quick? Joe,
do an introduction. Where are you guys at?
Check 1, check 2. We're in Dallas.
Who are you and why are you here?
We broke in.
Yeah, so we got questions. Just here to answer questions. Yeah. So anyway, what I'll share is that I had a gentleman. He hopped on the call, has 4 kids, 30 some years old, and has no coverage right now, no type of death benefit coverage, and that's very nerve-wracking for him. He's very scared about it because in the military, something happens to him. He has some coverage, I think, through them, but very kind of nervous about that situation. Wants to get some coverage, and I let him know that, hey, well, when you start the application process for infinite banking, if you put in 1 month of premium with the application, you have immediate coverage. Now you got to qualify for it, and there's, the death benefit is not 100% of what it is, but you have coverage day one when you start the application process. Even if you got denied down the road, you still have coverage for that underwriting time frame. And when he heard that, he was just so just happy, just so grateful that hey, I can pay in $400 and have coverage no matter what right now. So obviously he was doing that. So for everybody else, that was kind of a cool thing for him to experience.
Love it.
Yeah.
We did a call today that was just about an hour with a client that I've been talking to for a couple of years now, who just got his first policy in force this week. Funds drawn from the bank account and just started. So we were just taking an hour to chit chat and catch up and make sure that we're heading in the right direction. We know what we're focusing on, because once you've started your first private banking system, your infinite banking concept, and started that policy, you kind of get excited with the directions, and he's wanting to look at investing and all the options, just the overwhelm of excitement. But it was honing in on what's the next rung on the ladder that we're going to tackle. And first, you started paying yourself first. That's incredible. Like, you're the only one in your social circle doing it. But now we've got to go and start leveraging that and working to pay off debts. And so,
Absolutely.
yeah, just tackling the plans as usual with the clients. That was my big win for the week so far. It's only Wednesday.
Love it. All right, let's see. What does Shirley have? So Shirley has a question here. Should I use my policy to pay for my husband's work truck and have him make payments to our HELOC, or have it go to the segregated account? Appreciate your suggestions.
So buy the truck cash from the cash value in your policy, and then make a payment back to either the HELOC or a segregated account is the question, right?
Yeah. So, I mean, in most cases, all of your income is going to go through the HELOC first if you're doing an all-in-one or velocity banking. So when that money comes in that would go to the truck payment or now go to the policy payment, it's still going to go to the HELOC first and then come out of that HELOC to go into the policy loan, either through the segregated account or in the policy loan. But you're typically going to park it first in the HELOC so that you're knocking the balance down, reducing the amount of interest. So that's usually the way the cash flow would work. Is that correct, Joe?
Yeah, but I want to know, in the HELOC, do we have money in the HELOC? What are we doing with that money? Did we put it to work? Did we already debt consolidate? Now that money is in the policy, so yes, now we can go buy the truck or use the interest from the investment coming in. So, but like you said, every penny needs to come back. That comes into the house, goes into the HELOC, and then we use that money to run through the policy. Correct.
Yeah, and I think some of what you're saying, Joe, is we need to know what the truck loan is and how much available cash is in the HELOC.
Yeah.
That'd be part of the question too.
Everything has to make sense mathematically.
And I would just add to that too, that again, not knowing some of these variables, even if we're just looking at this as two debts of the truck debt and then the HELOC debt, even if we were to pay off the truck first, we're still recapturing that payment by moving it over and adding it onto the HELOC. Even if you're just treating that as its own separate thing. But again, obviously, hopefully, Shirley, if you're using Velocity Bank or some form of that, then yeah, you want to put that extra cash flow will go to your HELOC first.
And my Mustang payment, my cash value, all of it is being leveraged and is living in my HELOC. I'm using my HELOC to make the payments because I want to take the equity in mass and put that into an investment that's going to earn me cash flow and use the interest to cover the payment. But that interest coming from the investment is going into my HELOC and then going out to pay the car payment. But it ran through my policy first to get captured there. So it's working in the policy and it's living in the HELOC, reducing my interest.
If we are using the HELOC as a one-pot system, I want to know, why is there money in the policy?
That's what I was just saying. Yep.
Yep.
Are you not listening to me, Joe? Do you just tune me out now?
You're doing fabulous. Take control.
I hope that answered the question. Where did Brian go?
Let's see. Where's our next question here? Yeah, Brian fell out of his chair. His shoulder hurts. Hope he's okay, and he's going to come back here in a moment. He didn't really fall. I'm just saying that because we don't know where he is. He'll be right back. Let's see. Where's the next question, Al?
Kurt.
Well, let's see. Craig's an excellent bird watcher. Look at that.
Yes, Shauna and Harper were heading to the mall, and I shared with them, the type of. I made up a bird, and Harper got a little concerned over the name of it. But anyway, yeah, we were doing some bird watching.
Bird names are funny.
Yeah, and Shirley, I see Shirley asked, what is the name of the book that we recommend? I mean, this is the ultimate book to get for infinite banking, Becoming Your Own Banker by R. Nelson Nash. So
I think she was asking,
401k.
what was it for the
What about the
401k?
401k?
That would be the 501k plan to
There you
see
go.
where, yep.
And I would add
That's
one
what I
more.
have to say about it.
I'm back
Oh.
now.
I would add one more book to that 401k story is, so Brian, you had Andy Tanner on WTF a few weeks
That's
ago.
what
And
I'm talking about.
he wrote a book called 401k OS. So it's 401k and then AOS, standing for 401k. Yeah. Hey, Stephen Nagy here.
Brother?
Come on in. We're on Ask Me.
Oh, look who's on now.
What's up,
Boys and girls. What's happening?
Here comes the fun. What's up, Maggie?
You should be here. Is that what they say?
Yeah. Yeah.
You should take off that hat.
Next time.
Chris, come over and doing hello. Oh, I think he's eating lunch. Chris? Chris,
Yeah.
Welcome back, Brian. Everything
Not
good?
on a real party over
Power went
there.
out. My power went out. Yeah. So the joys of living in the country, perfect blue sky, and power just randomly goes out for 5 minutes. So yeah.
That was a
I
pretty
gotta get
fast
one of those
recovery.
devices- Yeah, so I got to get one of those devices that actually plug my internet into my computer, so that when that happens, it switches over to a battery. But I haven't done it yet, so now I know I need to do it right now. So what question, you guys, did we answer?
Where-
We had
Covered
just
Shirley's
answered
question.
Shirley's, so we're on to Kurt's.
Okay. So Kurt, hopefully my power stays on. All right. Question: do you make your premiums soon as possible so you can accrue interest while your money is in the PDF? Does your company offer this?
So you can accrue while you're on it.
So those are PDF is a premium deposit fund, and some companies offer those. Lafayette does, Guardian. So there are some options to do that.
Yeah, I mean, you can. I mean, it creates a taxable income, which is not a bad thing, obviously, in most cases. But if you can prepay your premium into your policy, you're going to earn dividends on it. So I'd rather prepay my premiums into my policy via quarterly or semi-annual premium to get the dividends higher earlier on than I probably would on the PDF. So a PDF is just an account you can put money into to prepay penalties for down the road, and the insurance company will give you interest on that money in the account.
I guess maybe, his
But it's not
realtor, if he had
accessible until
a,
it goes to cash value.
I guess it depends on how you cash flow. Maybe Kurt likes the idea that if he had a big, big sale or something, had a lot of cash flow coming in, wanted to have that money stored somewhere where he's not going to spend it or use it, and you can't fit it all into the annual premium or semi-annual or however he's cash flowing or set up his policy payment, then storing it in a PDF wouldn't be bad. But no, like Brian said, you will get a statement at the end of the year because you're going to get taxed on the growth in that before it goes into policy and starts growing tax-free.
Yeah. So cool.
But at least it's growing.
Yep, there you go. All right. THSH, so fish. What's the minimum amount needed to get started with an infinite banking policy?
You guys are doing great with the acronyms. I keep thinking, what are these people talking about? What are these acronyms?
I would say age times 10, right? So if you're 30 years old, we'd say 330 times 10. That's the kind of our starting amount where we'd want to see you saving at least 300 into the policy every month or on an equivalent annual basis, just so that there's enough for your age and makes sense with the cost of insurance, and there's enough to be able to borrow from. So if anybody else wants to add to that.
But that doesn't always work
I was
depending.
going to say, is there anyone here that wants to stop using the age times 10 thing? Because I'd like to raise my hand. I think that's the worst guide. It's a guide because we want to give an answer. And
So-
Ethan, it's not your answer that the problem is. It's just when we were getting in conversations, it really depends on what you're trying to accomplish. How much are you saving?
Very true.
How much are you earning? Like if you're not paying yourself 10%, no matter how much you're earning, then you're already not doing the first law of wealth. The first action for you would be to go start paying yourself 5%, 6%, and then 7% the next month, then 8%, and then 9% until you get comfortable changing that one thing and then paying yourself that amount. So that would be a better guideline for you.
Yeah. And knowing that you're just changing that one thing, and what you're creating is your own private banking system, your own infinite banking system, where you're capturing dollars that you earn today and going to be earning on them until you stop breathing. And then you're getting a tax-free death benefit going to your beneficiaries. I mean, knowing that, if you understood that, why would you be asking what the minimum amount is? How much do you want to capture and preserve in your family for the rest of your days? I would want to do more than the minimum. But yeah, I've heard the 10 times the age, and I don't like it.
The way I explain it is this. I always say, here's the range of what you can qualify for. That's how I explain it. I don't say so the lower end is this, the higher end is this. So you can work anywhere in between these two numbers.
Yep.
So
Like
that's
the IRS has that cap on it, and here's what that is. So
Craig, what do you have to say on this?
You know, my whole thought is, and I don't know if we have the link available, but I would put that in and just offer up a call, because really when we have questions like this, the minimum amount, we need to know what's going on in your specific situation. What are you trying to solve? And sometimes it's just a matter of moving the puzzle pieces around a little bit of your financial picture, and you might find out that you could do more than you thought. But if anyone's got the link and can put it in, you know, we do offer free strategy calls where we can go through your situation and figure out what makes most sense.
Sometimes when I ask people, how much money are you saving per month? How much money can we put into the policy that we wouldn't have access to? If I took a $100 bill and I lit it on fire at the end of the month, would it hurt your food, your living, your expenses? Would it hurt you? How about 200? How about 300? Okay. Where is that line? And then that's how I build it, by leaving that much in the policy and then putting as much money possible and running that through. So now you're getting paid for paying that credit card, for paying that car loan. Wouldn't you want to get paid for paying that credit card and paying that car loan? Of course you would.
I do.
I do too. And that's how one way is to do it also.
And to top it all off, if you are planning, if you are asking what's the minimum you should do, and you want a formula or a number, you could think 10 times your age. I also feel like, depending on your age, $500 to $1,000 a month. That's a decent range where it's like, okay, that's enough money where I feel like this is going to work for you. If you're going to do $200 a month, maybe if you're 20 years old, it might work, but anything older than that, it's a little tough to be working with. So if you could do at least $500 to $1,000 a month, I think that's a good place to start.
Love that point, Carson. It's not, for me, it's having enough skin in the game. You know, I've gone back and forth over the last 4 years with this and help people and say, hey, it's got to be, 10%, and this is where you do, and kind of held that line. And then I have people talk me into, hey, it's 10 times my age. I'm 36. I'm doing 360. And what I find is that you're not really taking this concept seriously, because if you go to page 85 of Nelson's book, part 2, it says, if you knew that at passive income time that every dollar you put into this would come back to you tax-free, would you hesitate to put more in earlier? That's a paraphrase of it. It's not verbatim, but that is the idea, is if you knew you're going to get all the money back, once you put more in that you could use tax-free later. And so that will help change your thinking.
Very good.
Yeah. Last thought on that is, again, with the savings part, I also, like asking, what are you already putting in the savings account, if you have it that way, or what are you putting into other savings places, such as your 401k, where you might be better served saving those dollars into your bank rather than giving the government control of those dollars too. So all good points. I like it.
Okay. All right. Mr. Billy MacArthur says, if you do a dump in, should you wait a year to start paying premiums, or should you start right away?
It depends.
Yeah, the dump in and the premiums are two separate things. So yeah, so they're two separate things.
Oh yeah, okay. So you're right. Some people think that a dump in is an annual payment, which it isn't. A dump in is something entirely different. The cherry on the top, I call it.
Yeah. So I mean, I have had people say that, hey, Brian, I want to put in $100,000 year one and have no premiums. And then year two, I can start paying monthly premiums. So in that scenario, what you're doing is let's say it's a $20,000 annualized premium and a $80,000 dump in. And then year two, it's $20,000 divided by 12 for monthly. So that is a way to do a large amount in up front with no premiums, and the premiums start with year two because you can change from annualized premiums to monthly.
And why might someone want to do that? Someone might want to do that because, like, say they had $100,000 from that came to them, whether it was through a sale of something, through maybe taking money out of their qualified plan, maybe they were left that money, and they really hadn't freed up any capital to save yet. But building it the way Brian just described, they're going to have 80 to 90% of that capital, pay off a bunch of debt. Now they have cash flow flowing back to them. What it does, it helps them pay your annual premium deposit. And you can change that every year. Like if you believe like we do, the wealthy have more choices. So you can change it from annual the first year to monthly the second year, do the dump in to have more capital to pay off the debts and take back control. Like that might be one reason you might do it. Or if you're already saving, you could do a larger part as a dump in and do it monthly. You could do it either way.
Yep. Or if you put that money into an investment, cash flows can go into the premiums year two, etc. All right. So Billy has another question here. It says, how does a loan repayment work alongside with premiums? Are able to show us a visual for learners? So, I mean, yeah, we can illustrate those for you. We just need to know your specific numbers and things like that. But it's just, yeah.
So here you have a premium. This is your 3-cup setup, Billy. This is just for you. Let's see, everyone. I've got some money here. Let me get some coins.
Use
this
cups,
is from the Banking Bros,
buckets.
Jeremiah and Jonah do. I am not cool enough to come up with something called the 3-cup setup. This is your premium. These are fancy paper cups. You can get them anywhere. This is a premium deposit cup. This is your loan or cash value cup. And this is your death benefit cup. You put money into cup number 1, it buys something. It's going to buy you a death benefit here, right? So now your cash value is coming out of here, Billy. So if you're making your premium deposits here, that always buys death benefit, gives you cash value every time. You take a loan from the middle cup. When you pay the loan back, it's going to the middle cup. Your premium deposits still go in this cup. So you're building up cash value here that you can use again. You're uncollateralizing this, and you're adding more premium deposits here. That's always giving you more death benefit and more cash value. So you got money coming into 2 separate areas if you want to think of it that way. Does that work for you guys?
Need to label your cups, but yeah.
Yes.
Sometimes I do them backwards. I remember that people are looking at the other way, and I remember to do it premium this versus that way. So sometimes I remember.
Love it.
My thing too is just knowing when you add to your premium, the portion, how it splits, portion of your dollar is going to go into the base, and that pays for the insurance. And then a portion is going to go to the PUA. That's your cash value. And that's what you can touch. So if you do a loan repayment, you're repaying towards what you already used from the cash value. You're not increasing. You're just making the funds available to utilize again. So keep that in mind too. I did velocity banking because I was prioritizing paying my loans back and putting my money back into the policy through premiums, getting out of my monthly towards annual, because I saw the benefit of having the dollars in the policy sooner.
There you go. All right, Lydia, cool. On a $45,000 or $4,500 dump in on a first policy, what kind of first loan dollar amount can you expect to borrow in the first 30 days? Is it a percentage of that $4,500? Yes, it is. Whip out my trusty calculator, which is my phone, and go 4,500 times 0.85. So $3,800 to around $4,000 would be the range, depending on what company stuff that you'd have available to borrow out.
Was that her? That's her dumping. Okay.
Yeah. So gotcha. We always say, 85 to 90% of that is going to be available in the first 30 days or at 30 days. Okay.
And then, of course, in addition to whatever you paid for your premium, whether it's the first month's premium or the first year's premium, then we can get into that as well based off of how much paid up additions when it's your premium.
Yep, exactly. So Kohei out of Seattle says, my wife is interested in opening up her own policy. We have about $300,000 to dump in. Would it be better to split that 300K into 2 policies or open up 1 policy and cycle that 300K into the next policy?
You went underwater there, but
I
You
did.
went underwater. I like that.
Did I go garbled?
you did
Not
a
just
little bit.
underwater. Just underwater. You were down with Dory under the sea. So
Oh yeah. Well,
I mean, I like the idea of getting coverage for both if
Yeah.
we can. And it also depends, is she like employed? Is she earning an income? Because if she's not, then we'd have to be going off of his income. And
that's
I
one of the
agree.
big
It's gonna depend.
questions.
It's going to depend. It's going to depend on a lot of things. Like if you're the primary breadwinner, then you might want to protect yourself first and then start an additional policy on her later. Or you might want to split it depending on how you're looking at that situation.
Yeah. Good question.
Well,
though,
the other part of this question that I see at the end is, should we open up one policy and cycle that 300 into the next? That sounds like a concept called laddering, which I don't like. I see a lot of people getting into trouble with those strategies. But the idea is you fund a policy, you take the cash value out of that to fund another policy.
Yeah.
I don't like that. If that's what you're thinking, it's not a good way to build a sustainable long-term system.
agreed.
Yep. All right, Mr. Justin says, when you start repaying your HELOC, when do you start redeploying that money saved up? Like once you hit 30K again, it can be a rough number to invest into another deal. Seems like most deals are around that. I don't. What'd you say, Joe?
Depends on what opportunity has your minimum, or are we to the point where we filled up the policy and all that's working and we're going to get another policy? Just depends on where is that money being deployed and how much do you need to deploy it.
And I love that you have Joe and Craig sitting side by side because their philosophies on this are
over here.
polar opposites, right? Like Craig, what do you call your fund? You say like your cushion, or you have a name for it?
I'm more conservative on how I deploy money out of my warehouse. And in Wealth Webinar, I think it was 2 weeks ago, I went through some of that. But some of the things I look at, Justin, are for the capital that is deployed, how much is at risk? So let's say, for example, you have 100,000 out working, and over time, someone has paid you back 50,000. That means I still have 50,000 out at risk, right? So if that deal went south, I would lose that 50. So part of what I think about is how much of my money in my warehouse is at risk. And I also look at how much money is still associated with a loan. So whether that's for my HELOC or for my policies. And so I just have some numbers in my own head where I feel comfortable when it's time to deploy. Now, if a really good deal comes along, a good opportunity comes along, I might go above those numbers. But those are some of the things that I look at. It's just how much capital is at risk. I also look at how much capital is out there with the loan against it.
And to be fair, if you're starting this and you're doing this for 3 months, totally different than if you've been doing this for 3 years.
Yeah.
Because you already have money out. Now, if you're just starting it, you're starting this stage, so you're trying to get money deployed as much as you can in the beginning to bring that cash flow in. Once you get that cash flow coming in, well, now you can kind of slow down a little bit and start putting it here and start, I call it squirreling up. Start squirreling up the funds a little bit, because now you don't have to be worried about deploying it to get that cash flow coming in. So there's different stages of the game that you have to incorporate too.
And to that point, which Joe makes a very good point, is if you take 100,000, you deploy it at 12%. Let's say it takes you 6-7 years to maybe even longer to pay it all back. When you get to the point where you have 200,000 out working, and you deploy 100 and you want to pay it back, now that 200,000 is working to pay that 100 back. It happens in half the time. Then someday you might have 500,000 out working, and it takes maybe 2 or 3 months to pay that 100,000 back. So it's just the more capital you have out there working, to Joe's point, is, when are you able to make some of those safer moves of being a little more aggressive? If you've got some capital out there working, you've got some of the the opportunity funds, emergency funds, some of that stuff set aside, then you can make some better decisions there.
That's a great segment right there. That should be its own video. Just you two doing that right there was, I'm telling you, that was brilliant. And there's two things that came up for me. One is Craig's strategy about how much is at risk is exactly what the insurance company is doing with everyone's policy. Like how much is at risk compared to the premiums that have been paid in to the death benefit. And that's what goes up to the 121. So I appreciate Craig's thinking. The other thing is the emotional component of it. Like if you're someone that's looking to go make your money, make money, and it feels very desperate and you have to do it and it feels very stressful and like, I got to go do this and do that. That is when you're most likely going to make mistakes. When you get to Joe's or maybe Craig or others point where they've done a ton of investments and they're really taking time to vet it, to know it, to like it, to understand it. And they know, even though it's at risk in an investment, they're feeling really confident that that's going to come back over time to them. And it's not always guaranteed, but they're acting from a different energy. Does that make sense? Because my first investment I ever did, I did it because I was trying to fill in the gap from making $180,000 a year and going back to like zero. And like, oh my God, I still have the same responsibility to my sons, to my wife, to my family, to the family of Ford and Hyundai and the mortgage. How do I do that? And I went and took money and took a loan and tried to make that work for me. And guess what? It didn't work out. I lost all of it plus what I financed.
Wow.
So watch where your energy is coming from. When ask yourself, am I doing this from confidence or desperation?
Yep. All right, Ms. Shirley says, back to that truck question. So she asked a question about the truck payment going to the HELOC. The truck gets paid from my husband business account, and I still have 4 years to go, 15%, 750 payments. So I think what you're talking about is paying that loan off with the policy. Then what you could do is have his business pay it back to you via an agreement, but pay it at maybe still at 15%, and keep the payment the same, keep the cash flow the same, except now you're capturing more interest because you're charging yourself 15%, paying back the policy loan at a lesser interest. You have a delta there, a spread. There's lots of ways you could do that. So if you have a policy or not, I'm not sure. Just get with your mentor or schedule a call with us and walk through that scenario. But yeah, interesting. All right, got quite a few more questions here. So Barry says, what is the difference between a policy that has the PUAs drop off at 4 years versus dropping off at 10 years? Is one more efficient than the other? Well, they're not any different policies. You're just choosing when to drop the PUAs off.
I've only seen. Now I saw this weekend on Saturday when I was down in South Florida speaking, where someone had a vehicle that we would never use to set up banking, but they basically did a 4-year policy, and then what the returns of that policy started a second policy for years 4 through 8. And the only reason they would have to do that, and I asked him this, was because you have the MEC 7 pay. And so you need to be able to cover that MEC 7 pay. And that's why they stack the policies in the IUL like that. So I've never seen PUAs drop off at 4 years.
I have. I've done it before.
You've done it?
Mm-hmm. Client requested it. Now, see, when I did it, though, so the term stayed on, though. So there was term on that one. I think there was term on that one. So the term stayed on for 7 years. But they asked, what would happen if I dropped the PUAs off? And so I showed them the illustration. But keep this in mind. It's just the option to drop them off. It's not a requirement to drop them off. If they wanted to drop them off at year 5, they'd have to call in us or call in the insurance company and say, please reduce the PUAs. So I showed them the option of what it looked like. And it was a very beautiful policy. I mean, it was very efficient, but they wanted to see it. So, yeah, so you can do that. But the more PUAs you put in, the more efficient the policy is going to be down the road because it's going to be earning more dividends and you have more cash flow and you can put more of it to work for you. So the longer the better is typically our answer.
And the PUA is what you can access. So
yeah.
Why wouldn't you want to pay yourself and pull it back?
It kind of goes back to mindset. If you run it through the policy, you're going to make dividends and interest on that until you stop breathing. Why would you want to stop getting paid for paying that credit card, for paying that car?
Yeah. And so follow up to that one right there is this one. So they have a policy with One America through Money Multiplier. PUAs drop off at 10 years, but the death benefit drops off as well. So and I'm not sure who wrote the policy for you, so I can't see it right now, of course. So yes, we normally do show the PUAs dropping off just because we want to show the efficiency of the policy at year 11 because it is very efficient. With One America, though, you don't have to drop the PUAs off at year 10. You'd have to actually call in once again to have them drop off. They don't do it automatically. Now, the reason why the death benefit probably drops off is because you probably have a 10-year term built into that policy to avoid the MEC. And so at year 11, the term cost drops off and the death benefit correspondingly reduces because the term is no longer there. That's what
Correct. And they might have had a dump in too, which would also be another rider, and it would also drop off that piece too. So
yeah. But you could actually, I think you can drop the term off at year 8, even if it's showing as 10 years, you can.
Correct.
And after it drops, you'll see in the policy that it'll start building back up. And then going up.
Yeah, you probably would want to drop that term off at year 8, but talk to your mentor about that first. But you probably would want to drop that off and recapture.
Depends how old you are. Like if you're older, right, we're dropping it off earlier. If you're younger and it's not a big cost and you can still put more in, then we're not, right? So it just depends.
Yep.
I always look at it as that's my opportunity to have increased my income to go and get my next policy.
Yeah.
So Joe's elbowing me to say we had a conversation earlier about some policy design, and something I've been doing recently is for a couple cases I put a 20-year term rider on because the people were in their 30s. The cost of the 7-year term rider versus the 10-year term rider versus the 20 was minimal. But yet what allowed them to do is they can continue to put in a lot of money in the policy for the first 20 years. So anyway, just some design considerations, and all of that comes down to understanding your specific situation, what you're trying to do, what you're trying to accomplish, what your cash flow is. But there's a lot of flexibility you as a policy owner have in how long you want to keep the term rider on. Even if it's a 20-year term rider, you can drop it at year 10 if you want. Just need to make sure it's not going to mech the policy. But all of those things are configurable. And
it depends on what company you're doing that with as well, right? Because, I mean, with Lafayette, it allows you to put a lot more PUAs. You can build it that way. One America, not so much, if I remember correctly.
Well, I mean, you can still run a 20-year term with One America or Lafayette. It just depends on, age and some other factors of does that term rider benefit you or not.
Yeah.
So.
All right, RJ says, how important, not important, is the overloan protection rider on Penn Mutual Whole Life, and why don't other carriers have it? Well, we don't really write with Penn Mutual very often because they are a direct recognition company, but I'm not sure on that rider.
Oh,
go ahead, Carson.
No, you're good.
No, you go ahead.
So this rider basically just allows you to not lapse the policy if you have too big of a loan compared to your cash value. And so there are some options similar to that we actually can put on policies. At One America, they have that loan limitation rider, which is pretty much the same thing. I think it's a tiny bit different, but there are things in place on these policies to help make sure you do not mech the policies or you do not lapse the policies. And as well, too, if you're constantly using your policy for banking and you're pretty aware of what's going on, you yourself will be your own overloan protection. But these riders are optional, and Penn Mutual has that as a great option to have.
Cool. Yeah, absolutely. The other thing I'll mention, too, is every time you have features like that, it's not just a gift. So there's oftentimes a cost.
Right.
But, I mean, it's a cool rider, and it offers a lot of flexibility so you don't blow the policy up. But all that stuff Carson just explained, One America and some others can do, but it's not a free thing. There's some cost to the policy.
And what you're both talking about, it's more of a behavior thing. Like if you're doing that to not blow up your policy, it means you're not paying back your loans, you're not paying back your loans compared to your cash value. So you're not taking very good care of your system if you're using that rider.
Well, and really where I think that rider applies for most folks is when you get to retirement age and you start doing, using your policy for supplemental retirement. You might start taking out 20, 30, 40, 50,000, whatever it is a year. And you do have to manage how much you're taking out so you don't harm the policy and say when you're 80 or 90. that rider does offer some safety in that even if you make a mistake, you're not going to blow the policy up.
Cool. All right. Timothy Lee says, why do you say to use or take a loan ASAP after starting a policy? What's the benefit? That's a good question. It depends on what you're going to use it for, to be honest.
Yeah, I think
You're trying to finance.
Some people come on our phone calls and meet with us, and they hear that Chris keeps saying you can take a loan in 30 days, and so they think that's what you're supposed to do. But it's like, no, that's just an option, and that's a cool thing to do. So we always market that, but that's not what you need to do. You can do the policy however you want. So if you want to take out a loan because you need to pay off some debt, let's do it. Awesome. If you're just using the policy as an opportunity fund and using it as a reserve of capital, no need to move money at all. So the policy is not going to perform better or worse if you have a loan right away or not. So it's really just a situational thing.
Money in motion makes money.
Yeah,
That's all
I was just going to say that when I had debt and was paycheck to paycheck, I was excited to see the cash value that first week, and I wanted to take a loan and see if it was real or if I was still dreaming. And sure enough, it was real. And then I was just using it again and again because I needed to keep paying off the debt. I needed to keep the money getting captured. I had things to do, business to be done. And now that I'm doing Joe's system, I follow my 4 rules for banking. So yeah, I want to keep the money in motion. And once it's captured in the policy and it's showing it's available, it's now done its work for me. It's captured. It's now working. And now I'm able to leverage it. If I have an opportunity, which I do because I have a HELOC, I want to take that cash value and put it back in my HELOC, which is acting as my savings account.
Yep. Yes, there are some people in Dallas.
Those guys.
Those guys.
There you go, right there. That's funny. All right, we got 10 more questions. Let's get through these ones. Barry says, is it better to do a yearly premium of say 100 or 12,000 and do a dump of 45, or do a larger premium and a smaller dump?
You're reading big numbers today, Brian. 45,000.
I'm just optimistic. So, I mean, that's another one. It depends. It depends on the short-term goal and the long-term goals. I mean, it really just depends. And that's why we do strategy calls and mentor calls, is to help you work through these kinds of questions. Because once again, without knowing your situation, what you're trying to accomplish, we really can't answer that. But here's the bottom line. It has to make sense to you. It can make sense to us, but that doesn't matter. It has to make sense to you. And our job is to help that happen. So
so book a call and we can talk about why what you're trying to accomplish. Like, what is your big vision? What are you trying to accomplish today? Can we help you do that depending on how much you're wanting to put on an annual basis? 'Cause remember, if you're thinking long term, then the more you're putting in, like if you said, hey, in 10 years, I'm going to put in, 12,000 a year, that's 120 grand I've stacked up in this opportunity fund to go to work for me. If that's part of the plan, then you want to take that into consideration, but tie it back to something you can do now. So you have that progress. I say it all the time. That progress is going to equal that happiness. It'll keep you going towards your goal.
Yeah. So this is these two extra questions from J10 are pretty good questions. So is direct versus non-direct recognition really matter? And loan rate versus dividend seems to offset. So I've been looking at a few pen policies that people have sent me recently. And so this is a kind of good question. So anybody have a good answer for that one?
I do.
I figured you would.
The reason I do is we had someone come to us and say, hey, my original illustration isn't lining up with what reality looks like. And I think they were in year 7. And
of a pen policy?
Pardon me?
Of a pen policy?
Pen mutual policy, which is direct recognition, which for those listening, direct recognition would mean when you take a policy loan, the dividend crediting will be impacted. Okay, so if you do a direct recognition, you take a loan, your dividend will be impacted. In a non-direct recognition company, when you take a policy loan, your dividend crediting will not be impacted. So what happened is this person didn't understand that. They were taking loans and only covering loan interest. So the principal was out there. Actually, they didn't pay the loan back for a few years. But essentially, the cash value was about $4,000 to $5,000 difference at year 6 or 7 than if they would have been paying the loans back. So in that case, yes, it does impact the policy. Now, if you're taking loans and repaying them back quickly, there's going to be less impact. But if you're taking loans, and just like what we're doing out here in Dallas, this week, we're talking about private money. So let's say we take money out of our policy, we put it into a deal, and we keep that money out working, and we're covering just the loan interest. That is going to impact the dividend crediting of the policy over time. And so, yes, there will be a challenge there.
Yeah. So I saw a pen policy, I think it was yesterday or the day before. Somebody this is a person I personally know, had done a 1035 for this client from Lafayette to Penn. Now, the Lafayette policy was built by, I don't know who the person was, but it was not a very good policy. And the person that built it didn't know what they were doing and admitted that eventually to a Penn policy. But here's the unfortunate thing. Oh, hey, Tess. But the unfortunate thing is that the client did not understand what Craig just said. They didn't understand what direct versus non-direct was. And if you are going to go with an agent or a broker that's going to do a Penn policy or Guardian, by the way, you have to understand what non-direct versus direct is, and it has to make sense to you. This person was pretty pissed off that I talked to yesterday because they were not told that. And that's our job as agents is to actually help you understand the ins and outs of the policy so you can be a good banker with it. And so, yeah, I told this person, I said, here's what you want to do. Go back to the agent who wrote the Penn policy and have them do an in-force illustration with a loan being taken out for 5 years of $60,000 and you paying it back, and then go look at your original illustration and see the difference in the cash value. That will show you the impact of direct versus non-direct. So they're doing that right now, and I'm very interested to see what it looks like. So J10, obviously, we've been talking. I do think it is important to understand it. So, yeah.
And we have Tess and Lori here. Say hi.
Hi.
Hey, Tess and Lori.
That's awesome. Lowski Financial Group. In Nelson's book, it mentions paying more than a standard car loan when paying back your policy loan. Is this applicable after your PUA period drop or falls off?
You have to have your PUAs attached to be able to do that. The only other way is that goes back into your segregated account. And, one of the companies we write with, you can actually add the additional PUAs back in as long as you have enough base in the comparison. And you can do that either with a rider added or without. So it's really nice. You can actually decide how much interest you want to pay yourself back and actually put it in the policy and buy additional PUAs, which is what your dividend buys. So,
yeah, good question though. Yeah, most people don't pick up on that. But in Nelson's, the policies back then were different than the ones they are today. But he always had more PUA room in those policies.
Well, that sent me down that rabbit hole 9 months ago. Carson and I have had this conversation a few times, and it sent me down a rabbit hole for a while. And actually, this is one of the big things I teach if people want to know it. So
yeah, that's good. It's awesome. All right, Knights of Israel. Haven't seen you here before. Are any of you using your IBC policies for everyday expenses, kind of like the one-pot system with a HELOC? If so, is it used the same as the HELOC method?
I was before this year, January 29th. I was putting all expenses on my credit cards to get the cash back, rewards, points, whatever I could get. And at the end of the month, I was taking policy loans to pay off the credit cards. And then when I had income coming in, I was either keeping it in my account to get up to a certain amount or putting it right back into the policy to pay towards those loans. In the process, I was reversing the interest rate that I was charged for those loans.
And so that's velocity banking. So Knight of Israel, that's velocity banking right there. But as far as borrowing from the cash value, if you don't have any loans and you borrow to pay for expenses, no, we don't typically recommend doing that until maybe later on down the road in like retirement when you can take out it and not pay it back for supplemental income. So
yeah, one caveat I'll add to that is so not for the everyday expenses, but I'll say for the every year expenses. If someone's in a situation where if they've got if you got all your debts paid off and you don't have the education or the ability to go and invest just yet, you can look at things like, do you have private school tuition, property taxes, even some boring stuff like car insurance? Can you pay that once or twice a year by taking a loan and then take that monthly portion you are diverting and sending out to somebody else and then recapture that back to your policy? Hopefully you guys heard that. I know looks like my video is lagging a little bit right now.
No, you sounded good.
Okay.
All All right, Billy, another question. If you never repay a loan, does the interest grow on the loan? Can it make your policy lapse? Yes and yes.
Yes.
So, so we don't recommend not paying the interest.
Mm-hmm.
We recommend at minimum paying the interest is what we typically recommend. But I've seen people that don't pay the interest back, but over time that it grows significantly. So,
Well,
That's not what he was asking. If you don't pay back the loan, I've never paid back a penny to my loan.
well, he's saying if you never pay back a loan, does the interest grow on that loan? Yeah, so it'll accumulate on top of itself if you don't pay the interest.
But every
Not
year,
paying the loan doesn't make your policy lapse. It's not
No,
paying
it's
that
the
interest.
So the more money that I'm putting into my policy, I take it right out. I throw that in the opportunity. I'm making more in the opportunity, but my interest is growing. But I'm using leverage and I'm making arbitrage.
and Joe, I think the important thing here to differentiate, if you can go back to that real quick, because the loan has a principal portion and an interest portion. And Joe, you're paying your interest.
Absolutely.
So
There you go. Thank you, Craig.
Yeah,
that's something that, yeah.
here's the thing is if you take a loan and you never pay the principal, it's fine as long as you're doing what Joe just described. You're out making more money with that money, but you're covering the loan interest. But if you don't pay the principal or the loan interest, then eventually you will get in trouble, and it could be year 25, could be year 30, but you will get in trouble.
Right. Yeah, and I've had a couple clients that were different companies set up the policy and told them that they don't have to pay the loan or the interest. And I caught them at year 7, and I was like, thankfully they heard one of our videos and they got in a call, and I said, no, let me show you. And I illustrated it, and it was with Lafayette, and I showed it, and it would definitely implode the policy. And that agent that sold that to them should not be doing this.
Yeah, and just to also clarify more on this too, if you have debt, a lot of times what we're showing you is taking loans from the policy to throw at the debt, and you're not paying back any policy loans or interest at that point until those debts are gone. However, when those debts are gone, you're then taking those payments and putting them back into the policy loan. So we are teaching you to repay the loan.
Right.
So there's some different situations there, but like Brian said, if someone's telling you just put the money in, take it out, never have to service the loan again, you're stealing from your own system, and it's going to cause problems down the road.
And Bree was doing it. She was not only just putting back and paying the loan, she was running more through it, even decreasing the interest on that. That she was doing.
Yeah.
Using her debts to grow wealth.
Yeah, like Billy, his scenario is if you have $6,000 saved in a high yield savings account and have $15,000 debt, how would you pay off that debt using IBC to create the cash flow? So that's kind of what we just said. The $6,000 would go through a policy, back into the debts, premiums go into the policy, keep growing the cash value, keep borrowing out, knocking down the debt. Once the debt's paid off, then that cash that's going to the debt goes back into the policy. That's what Craig's going to explain.
Perfect. And now if that debt's one $15,000 debt, or if it's smaller ones, you might recapture some of that and be able to start paying yourself back if you got like a 5,000 and a 10,000 or whatever, right? So it's going to depend.
Cool. All right, last two good questions here. So Lydia says, is the amount available each month available based on only off the premiums deposited or also off the loan repayments as well? Actually, that's a good question.
Both.
Yeah, based upon both. Yeah.
Both.
Yeah. So when you pay off the loan, when you put like a $500 back into the loan, then you got $500 30 days later available to borrow back out again. So, yeah, so it's actually both are working together. So like right there, $500 per month premium plus $3,000 loan repayment. Yeah, so
the $3,000 loan repayment, you have access to all of it again, and then the $500, you're going to have access to the portion that is going to be the cash value.
Mm-hmm. Yeah.
Stacking money.
There you go, Carson. You still flipping houses, Carson?
I kind of am. Yeah, good. It's interesting. I definitely would say I have had more properties that needed to go to Plan B. So common, however, in the markets I'm buying to, the price points are low enough where there's enough buyers where it's still moving. They're not as fast. Maybe there's a little bit lower asking price. A little bit offers are lower than asking price. That's typical anyways. So I would say there is a notable difference, but is it make or breaking the business model for me? Not quite yet.
Yeah. So Ryan says he has a policy from Guardian. Guardian's a great company, but they are direct recognition. needs help on what to do. He wants non-direct and wants to do the one pot system. Well, just schedule a call with us at mentors.beyourownbanker.com. Just schedule a call with us and we can kind of walk you through the options. It may or may not make sense to move the policy over. Just keep that in mind. But yeah, take every time with us.
So
I
Brianna,
still have my Guardian policy, and I'm doing the one pot HELOC system with Joe right now.
Yeah. Anybody have a cash value line of credit? So by the way, what that question is asking, you can actually have a bank give you a line of credit based upon the cash value of your policy being the collateral. So you can actually turn a direct recognition into non-direct by having a cash line of credit with a bank, which, by the way, is what Chris Noggle does because of how many policies he has. I've never done it, though.
I call it
That's what I was considering.
What's that, Joe?
I call it HELOCing policies.
I mean, you can have advantages to that because it makes it easier to manage, but you also now the bank's controlling how you pay it back, which is going to be structured.
Yes.
So you take away some of that control that you had doing that.
Yeah. So yeah, but the kind of the experience is it what he just said. You're now in the bank's hands again, so you just got to understand that and be responsible with it and stuff. But yeah. Let's see here. Timothy, how do you determine which company is best for the owner? I know mutual company is a given. I'm curious as to how you determine which one goes with. Ask me to consider good, etc. Case by case basis, I guess I would say. Depends on what you're trying to accomplish, what you're trying to solve. It's
Where you live,
yeah,
how old you are,
all that stuff.
how much you're earning, what you're trying to do. You know, Mass Mutual is an amazing company. They just don't want you taking out a loan you can't take out a loan in the first year. So if you're looking to actually start moving the money right away, that's not the company for you.
Yep. Yeah, you can get in trouble, with them. So you gotta be kind of careful with them. But all righty, guys. I think we got through all the questions.
All right.
There you go.
I like that too. And testing the middle, putting them up makes it even better.
That's awesome. That's awesome. Yeah. I'll help you, Ryan. You get in touch. Well, with that, guys, appreciate you all being here. And man, this is my third one today. I don't know how Chris does this. 3 events every day or every Wednesday. It's a lot of work. But
Hey, it was going to be my third too, but the first one I couldn't get logged in, so I've done. This is 2. This is number 2. I did one at 3, 3 to 4, and this one. So.
Oh, nice.
Well, and the other thing I want to mention is for all of you that watch the wealth webinar, the WTFs, all the shows, Tess is on all of them. You'll see her name. Here she is in live person.
And I had a Mr. Shane on, I think, on our call today too, as well, on both Wednesdays. So he was actually he's at the event, of course.
Yeah, he's here.
Yeah, so he was on as well. So yeah, he shared his experience. Yeah, that was kind of fun. So yeah, he shared his old experience and stuff. And he did a podcast with Chris here not too long ago, a couple of weeks ago. I think it just came out on his experience doing infinite banking and how he went from trading time for money, corporate America, to actually now his own boss.
Oh my
So he changed his whole thing. So
There he is.
There he is, the famous, the infamous. What's up,
So I got to
Shane?
talk to you a little bit ago.
Yeah, I know, right? Thank you
awesome.
for having me on.
Yeah, man, that was great. That was great. Glad you get to share the experience.
Yeah.
See what you're all missing?
I
That
know.
includes the audience.
Yep.
I'm learning so much just sitting at the table. We haven't even started yet.
That's when you're going to learn the most, actually, Shane, is pay attention.
There
What's
you go.
that, Jason?
That's when you're going to learn the most. You always learn the most like in the moments that aren't when things are being presented. It's just little things here and there people say. So
Yeah, I completely agree. And Jason, thanks for helping me get my policy started, buddy.
yeah, also it's awesome watching your journey. It makes me happy every time I see you. You're on everything, brother. So it's amazing. So
Well, I have-
enjoy the time in Dallas. We'll keep holding down the fort, y'all. And you know, if you haven't scheduled a call and you want to learn more, make sure you're doing that next week. Bring more questions so we can answer them and we can have some more fun with you and just keep bringing good questions. Fouts, you got anything else? Brain?
Nope. Just keep around the campfire, keep learning, and keep educating. That's where the power's at. So with that, everybody take care, and we'll see you on the next live stream.
All right, be blessed. Bye, all.
Hey guys.
Yeah.
Bye.